Assalamualaikum to Miss Ofza and all my fellow friends. My name is ANISAH Binti ANWAR. Today, me and my friends will explain about the technical analysis and two tools that I use, which is random walk theory and moving average. What is technical analysis? Technical analysis is a trading discipline employed to evaluate investment and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Technical analysis tools are used to scrutinize the way supply and demand for a security will affect changes in price, volume, and implied volatility. Technical analysis is often used to generate short-term trading signals from various charting tools, but can also help improve the evaluations of security strength or weakness relative to the broader market or one of its sector. This information help analysts to improve the overall valuations estimate. Next, I will move to the random walk theory. Random walk theory suggests that changes in stock price have the same distributions and are independent of each other. In short, random walk theory proclaims that stocks take a random and unpredictable path that makes all methods of predicting stock price futile in the long run. Random walk theory infers that the past movement or trend of a stock price or market cannot be used to predict its future movement. Random walk theory belief it's impossible to outperform the market without assuming additional risk. So, it considers technical analysis independent because it results in chartists only buying or selling security after a move has occurred. Random walk theory claims that investment advisors add little or no value to an investor portfolio. Critics of the theory contend that stocks do maintain price trends over time. In other words, it is possible to outperform from the market by carefully selecting entry and exit points from equity investment. Random walk theory maintains that the movements of stocks are actually unpredictable, lacking any pattern that can be exploited by the investor. This is an indirect opposition to technical analysis, which seeks to identify patterns in price and volume in order to buy and sell stocks at the right time. That's all from me. Next, I will pass to Husnina Hanis to explain about the moving average.
Hi, Assalamualaikum to Miss Fauzia and to all my fellow friends. My name is Husnina Hanis, Binti Fisol. I'm from KBA 242-4B and I'm here to inform to all of you about the moving average. What is moving average? In statistics, a moving average is a calculation used to analyze data points by creating a series of average of different subsets of the full data set. In finance, a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. By calculating the moving average, the impacts of random short-term fluctuation on the price of a stock over a specific time frame are mitigated. Okay, there are two types of moving average, which are simple moving average (SMA) and the second one is exponential moving average (EMA). Now I will explain what is simple moving average. Simple moving average is it is a simplest form of a moving average, which is it is calculated by taking the arithmetic mean of a given set of values. And as you can see on my right, here are the formula for simple moving average, which is the A is represented as the average in period N, and the N is represented as the number of time period. So In the other words, it is a set of number of prices in the case of financial instruments are added together and then divided by the number of prices in the set. And you can see the example of simple moving average on my right, which is it is based from the daily chart. Next, we will move on to the exponential moving average. It is a type of moving average that gives more weight to recent prices in an attempt to make it more responsive to new information. And as you can see on my right is the formula for EMA, which is the T is represented as today, which meanwhile the Y represent as the yesterday, and N is represented as the number of days in EMA, and the last one is K, which is represented as the 2 divided by in the bracket N plus 1. So to calculate an EMA, you must first compute the simple moving average over a particular time period, and you can see the example of the EMA chart on my right. So why the moving average is very important to the traders and analysts? First one is the moving average come from statistical analysis. So their most basic function is to create a series of average values of different subset of the full data set. So the moving average is a natural complement to any time series interpretation. A moving average also can smooth out the noise of random outliers and emphasize long-term trends. Technical analysts and stock market traders use moving average in an enormous number of tools, which many would not be possible, which is impossible for them to not use the application of the moving average, because there are few indicators that have been in the moving average that have been so reliable. The second one, why the moving average is very important for the traders and analysts, is the prices of security and value of indexes are volatile and unpredictable, which forcing traders to look for any advantage that enables them to reduce risk and increase the likelihood of profit. So the fundamental assumption of technical analysis holds that past performance can inform future movement, which is why they have to choose the moving average, because the moving average plays a central role in the determination of past price trends. So, as a conclusion, there are several different kinds of moving average calculation exist, but all of them are used to plot a line against either a price chart or another indicator. The direction and the slope of moving average lines inform investors about the relationship between the historical data values and present data values. The trading concept of divergence, confirmation, overbought and oversold, support and resistance, and many others have their own roots in moving average analysis. So I hope you understand what I have explained about the moving average and ANISAH have explained about the random walk theory. That's all from us. Thank you. Assalamualaikum warahmatullahi wabarakatuh.